Welcome to Crypto Talk with Brianna and Scott, where we are living the decentralized life. Join us for the latest crypto news, talk, and analysis. And now, here are J. Scott McMillan and Brianna Turk.
Hello and welcome. Episode 26 again. Wow, that's a great number, that episode 26. I just love it that maybe we're getting younger that way. This is Crypto Talk with Brianna and Scott, and I'm Scott. Hi, Brianna. How you doing?
Hey Scott, I'm great. Yes, episode 26. And yeah, it's funny. You said we should be dancing in the beginning. And I was just thinking about that because Scott, you're a good dancer. I can tell over there. I don't know if you want to see me dance. I can
Oh,
power
come on.
pose like all day long. I'll be in like a power stance, but I
Oh,
don't know. I'll say this. I am closer to dancing than I was a year ago.
okay.
There we go.
Power
That
pose.
tells you
Maybe
something.
we just have to take 4 or 5 of those poses and put them together. Power pose 1, 2, 3, 4, 5. Start again. No, I bet you're a good dancer. But we all have. I haven't danced for a while actually, but we'll see. Yeah, no, it's funny because we used to have that circle thing that would go on there, and now it's not there. I don't know where it went. So it just seems, if anybody watched the show before, it's like it used to be there was a transparent something over the top of it, and the circles dance, and we were in the background, and it felt like I was okay with that. But now that we were not, I don't know. I didn't like that. It's like I felt way too exposed at the beginning, just saying nothing and
Exactly.
waiting for the music to go. Oh, that's fun though.
Exactly. I was like 13 years old. I was thinking the exact same thing. I missed my veil. Missed having the veil,
Veil.
but
That's
yeah,
what it
we'll
is.
we'll figure something out. We'll figure
We'll have to
something out.
find the veil. Yeah, and so I'm in my new apartment. First time broadcasting from my new apartment, so I have no idea what it's gonna sound like, or visually it's boring in the background right now. But I was just telling Brianna that when you move into a new place and you don't know what you don't know, and I realized that during the daytime they're doing a lot of construction in this area, and so there's trucks, big trucks going by all day long. And thank God they stop at night, and it's nice and quiet at night, so that's more important. But we'll see what happens with the podcast. I may have to get a new mic, or we'll see what happens. But yeah, so if you hear some trucks, don't worry. So we'll see.
It's all good. Congratulations on your new apartment. That's
Yeah,
exciting.
thanks. Yeah.
Yeah, I kind of started out this week, which it has been. We're in the summer. Summer is coming to an end. We're approaching the fall of life, as I call it. So I'm in prepare mode a little bit for that. And I started this week and last week looking into the macro again. I haven't paid attention too much, to be honest, when it comes to the economy, just to take a little break. But I decided to dive back in a little bit just to see where we stand here, mainly in the United States. And it doesn't seem like that long ago that we were in the thick of that last winter where we had so many of those dire warnings. And last winter was going to be the cost of food, the cost of gas, the cost of energy, everything was through the roof. We were looking at places in Europe that were just, it appeared to be like there were some massive struggles, but we're struggling here in the US too. I can't believe the cost of food right now. It is just incredibly difficult to get by, that's for sure. And so I decided it was time to check in with myself with some true numbers rather than following the words of some of my favorite YouTubers, which I still love, but I wanted to get some little statistics going. I That's what I will be sharing today. I have a warning from the Bank of America, and we're going to look and see just what they're saying and some of their numbers, and maybe not so positive and uplifting, but hopefully helpful to know, serve as a guide as to how to prepare for this winter and what may be to come. But again, of course, nothing's set in stone. You never know. But that's
Yeah.
what I'm going to be sharing today. What are you gonna be sharing today, Scott?
I guess we're gonna bombard them on economy stuff. So I'm doing part two of my 4-part series on economic analysis in crypto. And so I talk about the short-term debt cycle today. We're going to talk about the long-term debt cycle, and then planning then next week or next time to talk about what's going on currently and what we can do in the future. So all of that will apply because I'll ramble on. We're going to talk about what's happening today too. So all those numbers will make sense. But I also have missed some of the news. So I wanted to just throw up a couple of articles, some of the news, because I actually missed looking into that and then talking about it each week. I'll just talk about a couple of things. I think we can fit that all in there. But first I want to say hi to Tigran, our fellow Kings member. Tigran is on the line. How you doing, buddy? Good to have you here. Yeah, let us know what you want to talk about or if you have any comments. Anyways, okay, let me just dive in real quick to a couple of articles, or just one actually. Let me grab my screen here, just share my screen, see if this works. Oh yeah. All right, there we go. Okay, just a couple things that this kind of shocked me. We've seen that the crypto market for sure has been going sideways. Stock market's been doing pretty good. But boy, I woke up and Bitcoin was at 26 today, and I guess it got down to just above 25 before it rallied. I think closed at 26.45. So that's pretty darn low, and it's interesting because it's been going sideways, which I'm like, I'm fine with that. But interesting to see this little drop, and I don't really have any data today. Maybe somebody watching has some other ideas. There's some speculation of what happened. I'm not worried or think it's that big of a deal, but it is just interesting that it dropped that low, and I didn't really expect that. But then again, this is crypto. These are markets. But 100 billion was wiped out overnight. Those numbers, it's like, what? But that's crypto for you. That's Bitcoin for you. But yeah, it just plummeted just over 25,000. So it hasn't been that low in a while. But all the other altcoins they went down too. So the whole market took a little blip. XRP here dropped 14%. Of all of them, I would have thought that XRP would have hung in there just because of its sort of big win with the SEC. What else we got? So anyways, I just wanted to touch that the reality of this is that I think what's interesting about it is that I feel like there's just a lot of hype and a lot of talk. And I put videos out a couple weeks ago. It's, hey, the bull market's coming. Let's get ready. And it is, but I think now it's pretty clear that it's going to probably not be until next year, which is not that far away now. We just get through the fall and the winter and we'll be there. Yeah, what else was going on? There was some speculation about this is Elon basically put out that SpaceX actually had to write down its value of Bitcoin. That may have caused it. But the funny thing is that they didn't sell it. They might have sold some, but really they just wrote it down. And it's funny, it's like this article's like, but they just wrote it down. They didn't sell or anything. But the market is so fickle that anytime Elon does anything, it seems like the market goes crazy, which I think is silly. It's the world we live in. So there may be other reasons, or there may be no reason. And really this is being Bitcoin and crypto, and the fact that it is stabilized, and I'm not sure, I think it will stabilize. I think it'll be fine. Here's one of our favorite topics, MasterCard getting into CBDCs. Oh, yay. So along with Ripple, Consensus, and Fireblocks, which these guys are getting into CBDCs. I don't know what it means necessarily by getting into it, but they're anticipating the future, like we all are, that there will be CBDCs. So these guys are the infrastructure, the backbone, the technology side. So they want to have products that the government can buy or whoever wants to buy these. And it's a free market. It makes sense. I don't really begrudge them from doing this other than it's evil, right? And they're helping out the evil one. I don't know really what this means, but it just means that as we've projected, CBDCs are coming. We just have to be vigilant about watching what they do with them and be prepared. But I saw an article about CBDCs and about the government coming out with this, and they're already painting a rosy picture about how convenient it's going to be to use these CBDCs. And we knew this was coming, but to really see it, because it sounds good. Even to me, I'm like, that sounds like that'll be a really cool thing. No, this is how they're buttering us up. They're buttering us up, getting us ready. So just again, many of us have an adverse reaction to the government and central bank plans for using CBDCs. Overreach of a technology that could give unprecedented access to spending, information, and even control. So it's good. This article was good. It basically showed both sides of it. We agree. Here's a fun little thing, but also interesting. McDonald's is giving away Grimace NFTs. This is only in, I believe it's Singapore. Yeah, Singapore. They're going to be on Ethereum and Polygon. But here's the interesting thing that caught my attention, because that's really no big deal. A lot of people are doing that. But they're soul bound. You can't trade them. They're basically, once that wallet mints that NFT, it's stuck to that wallet. And I have not really studied soul-bound tokens that much before. I know some of our friends, Petya, I think you know a lot about this, and I'm not sure you're in favor of this. Correct me if I'm wrong, but I need to do a little more research into that, and maybe Brianna, really these soul-bound tokens. But this seems very simple to me. The way this article described it just basically said, soul-bound in this case means that it's tied to the wallet. You can't trade it, which I think is great in this case. McDonald's doesn't want these. They might be able to even profit from having being traded and have the hype go up. But they look, we just want this to be like the toys you get in a kid's meal. We just want it to be a little prize that you get. And so I like that. I think that makes sense to keep what these are called soul-bound. And I don't know if soul-bound has other terms or other meanings. What say you, Brianna?
The first time I heard the term soul-bound was from Vitalik Buterin. And I did dive into it then, but I don't remember exactly what it all stood for. That'd be a good one to dive into in the future. But yeah, interesting. I'm not quite sure. I guess I'm trying to understand why you would want, I guess you just have a collection of NFTs that's your specific collection, but nothing that you can trade. Huh. It's interesting.
I think that's a better way to go. I'm not anti NFT trading. It's just that I'm not into it. And what I'm into it for is the utility of NFTs. So for me, this makes sense. I like this. I want to, every NFT I've bought, and I probably bought 6, are all just because I want them. I don't want to trade them. And I haven't bought any big ones that are like meant to be traded necessarily or have huge value. A lot of them are really cheap. They're just, in fact, I would say 4 or 5 out of the 6 that I have are all, the only reason I have them is to be included as a membership into a group that they use an NFT as your membership. I love that. That's what I think is powerful about them. I think the whole NFT trading thing is what caused a lot of hype and has caused a lot of FUD in crypto. And so I'm not a big fan of it. Although if I had a punk or an ape, maybe I'd feel differently. Can't afford them. Maybe I'd feel differently. Anyways.
That's interesting. I think the past of NFTs, I can definitely see where you're coming from with how a lot of that. But I also, looking into the future, there is some really exciting stuff because this is the way that I see a very small portion of sector of NFTs playing out. So looking into games and gaming, and just take like a basketball, say it was like a professional basketball game, for example. And let's just say that in whatever the game is, I'm not quite sure where this all exists or how it all works, but maybe it's in the metaverse. And I just picture like my kids or my son like playing and accumulating some NFTs because you get to have a pair of basketball shoes that your whole outfit and everything are different NFTs. And then maybe somebody becomes like a superstar player in the metaverse and all of a sudden their shoes become valuable and they can sell those and trade those. That aspect of it to me is exciting. In the gaming world, I see a huge place for NFTs now more than I ever have before, as I've just seen little things like that. And who may have owned a pair of, whether it was like Nike Air Force Ones, like if somebody owned it who was like a professional basketball player and then traded that NFT, that could be cool, trade around, but
I agree.
Yeah.
I like that concept a lot. And I think that that's what the gaming world is trying to do with NFTs, and it's a slow adoption because gamers just want to have great games. And they're ingrained into the concept that their assets that they buy are only available within the ecosystem that they're in. And they've been okay with that for so long as that they can flex their credibility within that ecosystem. What they don't really get yet, and part of it is because the games haven't been that good, the blockchain games, is that they're now going to be able to flex their across the whole metaverse or across multiple gaming platforms. So I think once that all starts to move forward, I think blockchain gaming and NFTs are going to be big, but they got to catch up. They've got to make sure that the games are just as good. And the funny thing is, in the early days, and it's what, 2 years ago when I call the early days, but when I first started looking at blockchain games, they were all about blockchain and about crypto and about learning how to mint this and trade this crypto for that. And I was geeking out on that, but I'm not a gamer. But if you're a gamer, you're looking at it like, I don't give a shit about this. I want good games. So I thought it was pretty funny how the industry started, but it's getting better and better. And we've talked about it. I think Illuvium, once it comes out live fully, lots of different games out there. And I've got 2 or 3 games that I have in my wallet and so on, and I've got a couple of NFT assets, but I just don't play enough. So we'll see. So yeah, I'm excited about the whole NFT thing, but more for what this is, like a utility. But yeah, it's cool that you could trade it. I think that's different than, I don't know what you even call those people that are just in it for the trade. They want a punk and a this and an ape, and they want ETH to go up because then they are worth thousands, millions more than what they bought them, and they want to trade them off. I don't have any. That's how they do with like wine and for all these other assets, and it's okay, but it tainted the NFT concept. It tainted even crypto. It really got the hype crazy, and people didn't understand, or they forgot, or they didn't pay attention to really what the basis of the ecosystem and how this thing is growing and what it can do. And it's just the type of society we're in. It's all about hype. So enough of that. Let's rock and roll into your presentation. Let me get your screen up here. There we go.
Okay.
All right, I'm looking forward to this. Go.
Yeah, we'll go over to the little bit more on the boring side, but
no, I find this really, hopefully nobody else finds it too boring. I find this super exciting, so go for it.
Good. I do too. Okay, here we go. Just coming in a little bit slowly, but it's coming. Just wait for it.
Wait for it. Yeah, once it loads, once it gets all buffered up, I think it'll be good. There we go.
Okay, should be good. Are you seeing my screen?
Yep.
Okay, so this is all coming from the Bank of America. Are we on the brink of a worldwide rich session? Have you heard that term before, Scott?
No.
Okay, my first time hearing it as well. So we'll go into what that means. And again, this was a warning put out by the Bank of America within the last, I think, like 72 hours. So this is going into what's just going on, our current economic status. So we have a record all-time high in debt currently in the US. Student loan debt equals over 56% of people with student loans pulled that they do not believe they will have to choose between paying, they do believe that they will have to choose between paying other bills or student loan debt. So they may have to choose between paying their electric bill or their student loan debt. They're coming to those, there's a massive amount at this time who are having these struggles. Credit card debt is also at an all-time high, over 1 trillion. People are underemployed right now currently and can't pay for the cost of living. Not only that, mortgage debt is at an all-time record high. So if the middle class, this is the warning from Bank of America, if the middle class gets squeezed, it destroys the wealth in our country and we move into a depression. And so this is known. We've known that the middle class has been getting squeezed for quite a while now, but this is a little bit different this time. So interest rates will likely move to 8% in the near future for housing. They're currently at 7.6%. Panic buyers are getting into longer term mortgages. They are now 40-year mortgages. And it takes an annual income of $117,000 for a married couple to afford basic cost of living and median home price. And the warning is that the rich session is real. Unemployment is rising. And so this is explaining what that means. Unemployment is rising for the 6-figure salary set. People making 125,000 and more are getting laid off faster than anybody else, and this is very untypical. So in the past, it's typically the lower class that gets the hit the hardest. Now we're having a little bit difference in that we have the people making over six figures that are getting hit harder than the lower class when it comes to unemployment. So we had back in 2022, President Joe Biden, he changed the definition of the word recession, and he changed this. The idea surrounding why he would have changed the word is because it causes consumers to curb spending when they hear the word recession. As soon as people are talking about recession, it's blasted all over the mainstream media. People, just like the hype in crypto, they take it the other way and they stop spending. And even more so when we're going into the store and realizing that we're paying the amount that we're paying, and we are like, whoa, that's a lot. Like, this is a lot. And we're seeing our bills stack up. As soon as that word recession hits, people just are like, okay, like that's looking into the future too much. And they're really starting to stock up and spend less. So the reality,
I'm getting people dizzy because I keep moving you back and forth because your words are switching sides. I'm like, oh, we'll move her to this side because then it won't affect the words. So I'm sorry if people are getting dizzy if we ran around.
You'll find there's no rhyme or reason to most of my presentations. I create them with my scattered creativity. So that's all part of it. So we may be headed toward the biggest crash since 1929, and that is what many people are thinking. The crash of 1929 was caused by wild money printing and a flu pandemic. And companies are currently trying to figure out ways of how they will survive. So by most figures, six-figure earners were most likely to survive the pandemic and post-pandemic. So back when this was all happening, back when we were in the thick of COVID, just by the figures themselves, those higher income earners, the six-figure earners, were most likely to survive. But now this is changing the game because there are higher layoffs when it comes to that class. There is a raised possibility of a recession around the corner if the wealthy don't cheer up. That is what Bank of America says. I'm not quite sure what they mean if the wealthy don't cheer up. Or
yay, pom-poms.
Yes.
Let's cheer up, everyone, even though we're in debt up to our eyeballs. Be happy.
Yeah, I've been trying to figure out what that means exactly. And maybe it's just maybe that those really high, like super elite, are just getting incredibly greedy. Maybe that's what it's referring to. And I don't know. I've been trying to figure out what that means. So keep in mind, whether you like them or not, the Bank of America does have some of the smartest guys in the room. They dissect data because they invest our money. They want to make as much as possible, and they want to give back as little as possible, like most banks. They're also trying to save themselves right now. So there was a meeting not long ago that was a public meeting, and I guess that the Bank of America was throwing a fit, really causing a ruckus and saying that they will not be able to compete with other world banks because they are being forced to hold back 2% of deposits for an emergency fund. That's crazy. Just 2% of deposits for an emergency fund is causing this like super big panic when it comes to this bank. And we also have heard warnings that a lot of banks, which I consider Bank of America a large bank, but that those banks will be also pushed out and there will be that consolidation of power into those world banks, which is not what we want.
Yeah, but I don't think we should feel too sorry for the banks and their little bit of whinings. Oh, we're so sorry. We're only making 50 billion instead of 100 billion. But their point is about all of this accumulated together and what all of this happens in high interest rates and the Fed's policy, all this stuff together does cause issues.
Yes, that's really an interesting point too that you pointed out there because of course, we don't even, especially us and the people here who we are in decentralized finance and the premise surrounding that, it's about being bankless. But we also, in this moment of time, it's, we don't want to be under that one world bank. So then again, it's catch-22. We do want these little banks to be around just to not have that consolidation of power to where we cannot spend in crypto, have our money in crypto. But it's,
until the bank will let us buy a loan, buy a house with Bitcoin, we're going to have to deal with banks for a while.
Yeah. So the households receiving unemployment benefits are up 75%, higher than the year before. more than double the rise in the lowest income bracket of houses making 50,000 or less. Oh, okay. So yeah, that's the unemployment rate. What is a typical recession? A typical recession crushes the poor, but merely inconveniences the wealthy. So this is a rich session would do the opposite, meaning luxury real estate and apparel drops. That's happening now. And popular restaurants and mid-range cars keep rolling off of the floor. The high earners are losing their jobs and will be slowing spending, causing an economic collapse because they're the ones who are putting most of the money back into the market, are those higher earners. So the wages at top income bracket have been flat this year, those six-figure earners, while rising 3% for the lowest paid third, as we've seen our higher wages, and 2% more for middle incomes.
Yeah, before you go on there, I think what's interesting, this is sort of a side note, but because when you look into what the Fed's doing, and they're, on the fence right now about whether they want to raise rates again to curb inflation, and a lot of their signals that they base this on are after the fact signals. They're not forward looking, so they've got to wait till the economy does something, and then they look at the numbers and they're like, oh, okay, now what should we do? And so one of the things is unemployment that has been throwing a monkey wrench in there and causing confusion, because in a lot of the sectors, unemployment is going down and wages are going up. And so I saw an article today that was basic. So let me finish that thought. So that means that the Fed is confused because they want to crush the economy. Not really, but right, they want to break something, they've said, to really hammer inflation. And so it's, if you follow some of the details, it's like some things are much better, some prices are down, but food prices are still really high. And I think a lot of it is energy prices have dropped. So that's part of it. Although the monkey business they do with the numbers sometimes includes or excludes energy from like the CPI numbers. But my point is that employment's really confusing right now. And this is that you pointed out there that generally this is what's happening is we've got this cost of living ratio of 2%, right? And so it said there, I think that can you go back to the slide before this?
Yeah.
3% for the lowest paid and 2% for the middle, which is interesting because it's not uniform, because some people are earning a lot more. Because after the pandemic, I think what happened, and this is the article I saw today, was that people started working from home, people left businesses altogether. And so as businesses started to scramble out of the pandemic, they had to, in some cases, raise the pay for certain jobs, like a ton, 20% or more for certain jobs and certain parts of the economy. And overall, the thought is that wages went up. So it's part of the reason also that the economy isn't like crashing, and that this recession that we keep hearing about hasn't really hit yet, because in some cases people got more money coming back to work. And so they're able to keep their spending going. And you're pointing out that what it's saying here is that this is saying that the middle class, they're not getting as much money as they used to. They got an average of 2%, where maybe in the past they would have got 4 or 5. And the lower class, maybe they get nothing. But now it's reversed. But they're getting 3%. I'm not sure why that is, other than I can tell you here in Montana, they can't find enough workers to work these lower paying jobs. So they've got to raise rates to get anyone to work. Not anyone, but in a lot of cases. I don't know if that's the case everywhere, but I just find this interesting because unemployment is the one thing that's a little weird and shaky, and it isn't portraying the way it usually should. And so this pay raise and pay grade, what's really happening. And I think what we're seeing here is that it's just not uniform across the country at all, because everybody is taking a hit, or employment numbers are taking a hit, but wages are going up for everybody. And the last point on this is that sort of a tangible point is that this is what they want, 2%. The Fed wants 2% every year to target their inflation, right? which means, and this is a big pet peeve of mine, is that 2% means that every year, everybody in America or everybody everywhere better be getting a 2% raise. And if you aren't, then you're losing money. Every year, the Fed is literally taxing you. It's like a tax. And if you're in a lower income job that pays minimum wage, are you getting 2% a year? I actually don't even know. All I know is I didn't have a super high paying job, but I work as an executive with a Fortune 500 company. And in the early 20 years ago, I was getting 7, 8, 9, 10% raises all the time. In the last 10 years, I'd be lucky to get 2%, 3% or whatever. And I was barely keeping up with inflation, but I was, because back then it was 2%. What's happening now that inflation was 8%, even now at 4 or 5 or whatever it is? These 2 and 3% raises, they don't even make up for inflation. So every year you're losing money. Mm-hmm. And this is why I'm saying, if you aren't saving some money in something that's earning over inflation, you lose money. So when inflation a month ago or a year ago, inflation was 8%, where are you going to earn 8%? Crypto was really the only place you could. And I've been earning 10, 15, 20, 30% on my savings because I'm in DeFi. Now, I'm not saying it's for everybody, but to me, it was just like so loud and clear. Why would I go to a bank and earn, even in the good days, 4 or 5%? Now, 1.5%.
Right.
And if I'm not saving at all, then I'm really losing money. So this is all about the economy, how the minutia works, and how all these things fit together, and how most of us don't think about how all these little things add up to, like, where should I invest? And for me, all of this study of the economy is to help me understand better where to invest my money, and then also to help other people think of that too. So it's interesting because your presentation is really cool about what's happening right now. When I get to my presentation, it's going to be about what has happened in history and kind of answer why these things are happening. So it's going to dovetail really nicely together. And we didn't even plan this. Cool.
Perfect.
All right, sorry to interrupt. Go ahead.
No, that was good. Okay, so yeah, I haven't read this one yet. So Americans earning $125,000 a year are laid off at 3 times of a rate of those with low or moderate incomes. So Meta, Amazon, Alphabet, and other Silicon Valley companies, they laid off 227,000 people since the beginning of this year. And construction and restaurants are still hiring. On the other side of that, or same side of that, Goldman Sachs, Morgan Stanley, Citigroup let go of thousands of employees. And in 2022, the richest 500 people on the planet lost a collective $1.4 trillion. So the wealth gap is important, is what Bank of America says, because overall unemployment figures remain low at this time. It's the divergence between income groups that is concerning for Bank of America. So unemployment is picking up for higher income earners. They blame the Fed interest rate hikes for disproportionately hitting higher paying tech and finance sectors. Tech layoffs surged by factors of 16, and tech and finance layoffs while restaurants are still hiring. Like you pointed out, we have that here in North Idaho. Restaurants are hiring. Everywhere you look, there are now hiring signs. So what happens next? The fear is that the world catches on, which I think many people who are paying attention have caught on, that we are in some murky waters. So the talks are now, which there is, who knows, that anything can happen, but that in the next 8 to 12 weeks, potential greatest collapse in history. This is a warning I've heard from a number of people. Whether or not they're accurate, who's to know? But it'll be interesting to see. I remember before last winter, and that was getting rough, they were saying, just wait till next winter, this winter. So we'll see what happens. So what can you do? Am I going to start doing? I'm going to stop collecting debt, continue to get out of debt, keep an eye on the big picture, and stay ahead of time by looking back in history, which is perfect because we can do that now with your presentation, Scott, what you have. And then keeping smaller banks in business versus moving into a world bank. That was advice. I don't know how we can be a part of that and making that happen, but that is more optimal to have smaller banks in business versus it all consolidating down to those world banks. So
I think we should add one more to this, and that is watch Crypto Talk with Brianna and Scott so you're in the know. I think that'd help.
Yes, yes. I meant to add that. I really did.
Yeah.
I was going to add something on those lines. I promise, and I didn't get to it. But yeah, so that's where we are. I just feel better this year. The warnings are getting more like, and all of the talk is just more familiar now, and it's just to a point where you can only do the best you can do, and just to see what you can do to best prepare yourself and your family, see what restaurants you want to work for. And I think I would choose construction over restaurants if it comes down to it. I like that kind of work. So that's where my mind is.
Yeah, leave this. Yeah, the warning thing is interesting. I hear this too, and when you start paying attention to any sort of investing and financial news, you start getting a mix of good educational information. At least I collect newsletters now on the whole finance and crypto, but I also get I call them conspiracy theory, but it's really just fear mongering, where they're like, oh, it's going to collapse. You better pay attention to this. The economy is going to collapse. The world economy is going to collapse. Of course, they don't say that. But if you watch, they use these sort of provocative, you need to watch this video right now, right? This will prepare you. And then they get in there, and the first part of the whole thing is about the doom, the gloom. The worst things are going to happen. The dollar's going to crash. The economy's crashing. But if you buy my newsletter and buy my financial advice, I will save you from all that, because I'm going to tell you what you can invest in now so that when it crashes, you're going to be fine. And I think that's funny. I watch them. I watch a lot of them just because I want to know like what they're saying, and then look back and say, okay, does any part of this make sense? And a part of it does. And this is really what I'm doing. And so in a way, I'm doing the same thing, but I really just don't like to use those fear words. And it's interesting because now for Bank of America, most of the main players don't use words like that. And so for them to actually say 8 to 12 weeks, that's pretty surprising to me that there could be a collapse, because even the doomsdayers don't ever give a date. Sometimes they do. They say near term, coming, whatever. But most of them don't. And how can you? Because we don't know what's actually going to tip it over. But what the feeling that I get, and I'm going to talk about it in my presentation in a minute here, but it's clear that all the numbers and the history and everything's adding up that something is coming that probably will disrupt us all. But nobody that I can find good evidence, and there's definitely no collective agreement on when that's going to happen. So I just say probably not in a year, probably not in 2 years, maybe in 2 years though, but 5 years, 10 years, probably. So that's just me. That's my personal thing. But from all the data I gather, I don't think it's going to happen this year. But I just saw a couple of them today, respected people that like Bank of America saying there's some things lining up. Did you hear, where did I hear this? That, it was in one of my groups. I can't remember the guy's name. He's a very well-respected investor. He actually shorted the S&P 500. What he's saying is that the whole stock market's going to crash, and he did it by $2 billion. Like he shorted S&P 500 by $2 billion. So the deal is, and this was a very well-respected hedge fund manager. If he loses his whole firm, that $2 billion, he pretty much gets wiped out if he wins big. That was scary to me and to the people that are talking about it. Man, this is a smart guy that hasn't really made bad mistakes before, and he's pretty much betting that the stock market's going to crash. There's definitely information like that out there. Yeah,
I haven't heard. That's a bold move.
Yeah, it's crazy times, but I'm still in the camp of it cut to the end. I'm in all of this, and the reason that I'm talking about economics is the same reason that you are, and that a lot of us are, and I think we should be, okay, what do we do with our money right now? Or what can we prepare for the future? And so I love looking at the history to figure out why is it doing this. And it's not a perfect one-to-one, but if we know what happened in history, we can predict the future. We can't predict it, but we can guess better. That's the way I look at it, right? Even technical analysis charts says no chart can predict the future, but it can tell you where it's going, based on past history. So that was really good. I like that now because there was a lot of good information about right now. What my presentation is going to do now is just go back into history and look at all of this stuff that's happening right now and show the biggest thing. It's going to show that this is no different, people. This isn't some once in a lifetime deal. This is not like, we shouldn't be, it's painful, but it's not, oh my God, I can't believe this is happening to me or this is going to happen. This happens all the time across the world. And what that tells me is that just prepare the best you can. And even if it doesn't happen for another 10 years, it's never too early to start. All right.
Yeah. Let's go back in history. Let's do it.
Let's take a little dive into history. Let's see. Okay, here we go. Money. All right, so just like last time, because what I'm doing this series, I'm writing the article in the newsletter, comes out in the newsletter. I'm creating a video for my YouTube channel, and then I'm sharing it here. Instead of creating whole new slides, I'll just toggle through this video. Okay. So basically last time I talked about the short-term debt cycle. So really, a lot of what you were talking about is a little combination of both, short-term and the long-term debt cycle. But there's three things that drive the economy, and that's productivity, short and long-term debt cycles. There's multiple other things in the detail, but in the overall, if you can understand these cycles, then you just understand what's happening. I mean, in general, right? So we're going to look at, so the short-term debt cycles cycle along 5 to 8 years over and over. We get into debt, we expand, we contract, we expand, we contract. The Fed comes in and produces more liquidity, that expands. We get too much debt and it contracts a little bit. And that's what we've been seeing for a long time. Now, the long-term debt cycle is 75 to 100 years, and it's a whole bunch of, the small little cycles, but it's all based on debt. Debt is what produces all of this. So by examining these cycles, we can better comprehend what is the economic position, and we can start to strategize for our financial stability moving forward. All right, here's the big deal, is that, I keep pushing the wrong button. Every cycle that we go through, every short-term cycle, we get more debt and we get higher and higher. We're just expanding this big bubble, the way I look at it. Every time that we have a mini recession, the Fed comes in and produces more liquidity. That means more people are borrowing. The Fed is borrowing, and we boost up the economy again. Wages go up. Things are looking good. People borrow more. And by the time it gets too hot and then it has to cycle down again, the debt is bigger this time than it was last time. And just think about that. Every year for 100 years, it just gets bigger and bigger. Even though these cycles that we just talked about, and a lot of things Brianna talked about in that situation, is what's happening all the time, every 5 to 8 years, just cycling through. But every time it's getting bigger and bigger. And the question is, how long can that last? And that's what Bank of America is talking about. There's lots of little factors, but in general, how long can this last? Because at some point, the debt gets so big that all you're doing is paying off your debt. If all you're doing with any money that you get from taxes or any money that you borrow goes to paying off your debt, then no money is going into the economic engine to produce productivity. So your productivity is really low. This is the key of this whole thing, is that what keeps productivity high? When productivity is high, that's what really drives the economy. But what's happening is we've enlarged our debt so much over all these cycles that we're now spending all of the energy of an economy in paying off the debt and nothing back into creating productivity. Now, this isn't in my presentation, but and I'll talk more about this next week, but we're also coupling all of this with lower births and higher deaths. So basically, we're having a lower population. So with lower population, you just have less productivity. You don't have an engine to drive productivity. Every country, for the most part now, are going down. And so that affects GDP. And so if you're spending all your economic cycles paying off your debt, your population's going down, you don't have enough people to actually work, how can GDP go up? And if GDP is going down, then that's going to lead to something not so good overall. Let me just preface by saying that at the end of my series, I'm going to have at least the best news that I can find. There is some good news. There are some saviors that could happen. So just keep that in mind. So you've got credit flowing freely. This is the workup still. People are becoming more indebted though. And everyone is happy though, because all these little short-term cycles, they're all still happy, but how long can it last? But everything's rising. And then the debt just gets bigger and bigger, and finally you have this bubble, and these are the little 5 to 8 year bubbles. But then here we go. You've got to have the slowing down again. And so it's just this expansion and contraction over and over. But why are people like Bank of America saying that there's something different now than the past? And we'll talk about that in a minute. But we can just start to see as it starts to contract, you've got decades now of you've got all this debt repayment. And the debt repayment, it says here, grows faster than your incomes. Because again, every time you end one of these cycles, your debt is bigger. So now you've got to take more money, you got to borrow more money to pay off the debt. And so this, finally, to do that, you've got to reduce cuts. You got to cut spending, you got to reduce borrowing. If you cut spending and reduce borrowing, what does that do to the economy? It slows it down. And that's, in the short-term cycles, that's fine. That's how the economies work. But it just starts to spin out. You've got people cutting back on their spending. And this is Ray Dalio's quote, and he says it over and over, and I like it. Since one person's spending is another person's income, incomes go down. Because spending goes down, that was someone else's income. If I'm going to buy things, someone else is going to use that as their income. It's all going down. That's where it pushes everything down. It makes people less creditworthy, which, again, Carl, makes money go down, and you have long-term debt. So this happened in 1929, as Brianna pointed out, due to a lot of factors, but basically that was a huge debt bubble that just, they had no idea how to manage it back then. Now, what happened in 2008 was also the same thing, really, that happened in 1929. It was a massive debt bubble. It was basically mortgages. They pumped up all these mortgages in from like 2000 up to 2007 or 8 before it crashed. And they were giving loans to people that really should have never been able to afford a loan in a house, but that was what the market was doing. And Wall Street had created these special financial packages to incentivize banks to go out there and loan to people that really couldn't afford loans. And it just was this huge bubble, and it was all debt driven. And when the housing market started to go down in 2006 and 7, all of these major banks who had leveraged up on all of this money, betting that this would just last forever and everybody would be able to repay their loans forever, that didn't happen. So they all were starting to default. And if you haven't yet, and you find this stuff interesting, go back and study the 2008-2009 crash or potential crash, because it's fascinating, because we were so on the verge of world financial meltdown. And the government had to step in. They had to step in and to bail out these banks. And it caused a lot of concern for people, because like, why are you giving all these banks money? They had to. Otherwise, if they started crashing, it would have spread across the world. We would have had worse than 1929 crash and depression. But the problem was, and just rambling on here, the problem was that after they did get the economy back in line, the problem that we're seeing now with interest rates rising was caused by the Fed and the government keeping interest rates artificially low after 2008. They should have let the market fluctuate and let interest rates rise a little bit, but we were all on crack cocaine. and everybody wanted the money to flow. Nobody wanted the Fed to come in. The Fed actually tried twice to come in and raise rates a little bit to slow things down a little bit, but both presidential policies at that time were like, no, this isn't good for election cycles. We're coming up on election cycles, so just watch what happens here. Do you think the Fed's going to keep tightening into this next election? I don't think so. But anyways, so all of this happened in 2008 again, and it had to be recycled. So it did, and the Fed pushed all this money in liquidity, money printing, basically. This also happened in other parts of the country or in the world, like Japan. The same thing happened in Japan in '89 and to other countries. But the cycle is going to reach its peak, and here's the word deleveraging. Deleveraging is a really nasty word. When you start to hear the word deleveraging, it means the beginning of a depression type feeling. I'm surprised that Bank of America actually used the word depression. It's not a word that a lot of financial people ever like to utter. It's almost like the one not to be mentioned. But deleveraging is basically just means you've got to go through all the painful stuff that in the short-term debt cycles, the Fed comes in and always rescues a lot of pain. There's some pain, but a lot of pain, they don't let it get that far. But in a deleveraging situation, after this long-term cycle after cycle, you just can't help it anymore. And so you've got to actually do really painful things. And so that starts to happen. And when that happens, everything has to drop. Asset prices drop. You come into definitely a recession, and you've got, I'll just tick them off. Less spending, less income, less wealth, less credit, less borrowing. Boom, a recession. But here's the difference between the long-term debt and the short-term debt cycles. In the short-term debt cycles, the Fed comes in, they lower interest rates, they print some money, they inject liquidity into the system, and it eventually all comes back up within a year or two at the most. The problem when you've got the long-term debt cycle, which I don't know, no one's really talking about this, but I think we're at the end of it. We're at the end of our long-term debt cycle. We're in the middle of it, let's put it that way. The Fed, we're in the middle. The Fed they just raised interest rates to slow things down because interest rates got so high, right? Or inflation got so high. But here's the problem. Eventually, it's going to get to the point where they can't lower interest rates any lower. They were at zero for so long. And they've already pushed so much liquidity into the system that the system is just sloshing around with all of this money, but it's not being used. It's not stimulating the economy. It's being inefficiently used. And that's because it's so big. The debt is so big. This is the difference. This is where depression can come in. And this is what Bank of America is talking about. They use the word depression. You've now got to put these short-term strategies into place, but it actually makes things worse because you've tried it all before. The same things that worked for the short-term debt cycles now don't work anymore. And really, the debt burden is so big that there's really nothing you can do. And so what happens next? And again, this is, if you look back in history, hundreds and thousands of years, it's just every 100 years this happens. We're about at that 100-year time frame. But what happens is you've got, the economy is so bad, depression is right on the brink. We've been in recession for a while at this point, so it's already bad, but there's just really no hope. And so now we have social and political unrest, and it starts to escalate. Now, we've started to see this in the last 10 years. But there are strategies, and here's what the Fed and here's what the government has to do. First thing they've got to do is they've got to do massive debt restriction. They've got to do wealth redistribution. We'll talk about that in a minute. And what they do is they start to cut things, but again, it doesn't make anything better at first. And so it's just no matter what they do, it's just more pain, which just makes everybody sad. And it is not good times.
It's sad.
Just big sad face. And when the job losses go, people start defaulting on their credit card, on their houses in droves. And pretty soon they're thinking the banks are going to go under because nobody's repaying their debts. The banks aren't making any money. They're losing money fast. And you have bank runs. You have long lines at the bank, people trying to get their money out, and basically it just starts to cycle on itself, and the sharks are in the water, and everybody's just trying to get what they can get. And at first, this is the crazy part, no matter what the Fed does and the government does, anybody does, it just gets worse. So basically what happens is now you've got to really raise taxes. And what happens is, this is that wealth distribution that you were talking about, Brianna, is now you've got to, the wealth starts to be taxed out from the rich to the poor, but the rich start getting pissed. The poor didn't get enough. It's not really working. Everybody takes to the streets now because it's anarchy. You've got but the government, who's getting less income because they're raising taxes, but it's not enough because the debt burden is so big that every penny that they can borrow or earn has to go to repaying the debt. And so people are in need of help. And so the government's got to spend money to help people, or it just will look terrible. If we just let people starve to death, we can't do that. So they continue to raise taxes. The wealth gets distributed, though. It starts to really move around in major areas like we've never seen in our life. But this is when unrest gets really bad. And you start seeing anarchy in the streets. Again, I'm talking about the long term now. And just when the country internally is fighting, that's when wars can happen, because, hey, we're busy trying to figure out our own shit. We're taking our eye off of China and Russia and Iran or whatever. And that would be the time that they would come and hit us, I would think. Okay, so that's a really bad picture to end on. But my point is that we are in the 100-year cycle. We're at the end of it. Now, it could be another 25 years before we really get to this. And we don't want it to get to this. We're still in these 5 to 8 year cycles. We're in the middle of one right now, right? So we just had the pandemic, kind of threw things, a monkey wrench into things, but it really was this 2008 that you look back, and that was a classic short-term debt cycle where, because of debt, it just got out of hand, and then it crashed. And then the government had to come in, the Fed, and inject more money than they had ever injected into the system to right the ship again, which they did. But they left the money printer available and left it on. And this is what most people in crypto talk about. Since 2008 is the demark of when, if we'd have done things differently and had not so much fiscal or Fed interference and just let the market play out, we may not be in the situation we are today, but we didn't. And the funny thing is that this happens all the time. Now, the details every 100 years are maybe a little different, but about every 100 years, this shit happens. And I'll talk more about, okay, where are we now, next time? And then what can we do in the future? But not to leave everybody hanging on this sort of negative viewpoint. As I mentioned about productivity has been very stagnant since 2008. All we've been doing is boosting the economy with debt and with money printing. That's why things are going. Why, when interest rates got so high, which normally isn't a good thing, and then the Fed came in and raised interest rates so high that it actually failed some banks because they couldn't deal with the interest rates being raised so fast. Why in the world is the stock market as high as it's ever been, or close to it, and looking like it might reach all-time highs? That doesn't make any sense. It's because all of this debt is just floating in there, and people are not willing to even really look at the economy. And when the stock market looks good, people they think they are good, especially the rich people. Because when I say rich, the higher end people, they're investing in stock markets. The lower economy's not. But when the higher income people are investing in stocks and stock markets going good, things look good. Hey, we're all happy. But underneath, the ship is sinking. So that's where we are right now. So it's not making sense. We're not in an area that makes sense right now. So usually when that happens, the economy knows what it's doing. The financial markets knows what they're doing. The economy is going to cycle the way the economy is going to cycle based on human conditions, the way humans act. So something's going to happen. Just like Brianna's presentation said, something's going to happen. But my thing is, I don't know if that's 1, 2, 5, 10, or 20 years. We don't really know. But here's the thing. AI and big tech can reverse this productivity cycle problem, which is really bad. When you start looking at the age, our population's going smaller. 20, 30, 40, 50 years ago, if the population was going down, you had no way to create productivity. But we do now with tech. Tech's always come to the survival. It's always come to the rescue. And I think now more than ever, with AI, robotics, Internet of Things, quantum computing, that will make up for losing population and for wasting all the energy of taxes and borrowing that the government does on just paying off the debt. That is so economically not efficient. But tech probably will solve. That's my hope. And that's like the hope of the future. It could alleviate all of this. And maybe we won't go into the 100-year cycle, or maybe it'll more from, maybe there'll be like a 100-year soft landing. I don't even know if that's a thing. But yeah, I'm going to end there. And I'll just say, because we're 8 minutes after the hour, is that today we inundated you guys with not such great news, a lot of minutia about economics. And it's funny, we didn't talk about crypto very much at all. In fact, had we not talked about some of that news, we wouldn't hit crypto at all. But the point of all this is, for me and for Brianna, and hopefully for other people out there, is that if you're hearing about the doom and gloom, what are you going to do? Are you going to sit there and cower, or are you going to have a plan? And if you're going to create a plan, what are you going to create that plan on? You better not just pull it out of the air. You better have some reason. So when you go back into history and you look, well, what happened in the past? And why did it happen? And what did people try to do to fix it, or what worked and what didn't work? And you can see that debt really is the whole culprit here. Debt's a great thing. Our economy wouldn't be where it is today without debt, without that concept of borrowing. It runs capitalism and economic powers. But eventually it always gets out of hand. What could change that? I don't know. But for personally, like Brianna's little list said, get out of debt. Start looking at saving, and then start looking at where can you put money that's outside the system. So if the system does crash, what happens? So clearly all this is, the only reason I'm even talking about this and that we're really focusing on this is that we're crypto people. So crypto is a place. It's the first time that any time before history, we now have a complete alternative financial system that we could go to in the case of a crisis. It's not fully baked out and ready to rock and roll, but if Brianna needed some money and the economy crashed or whatever, I could take crypto, valuable crypto, and send it to her directly, bypass the whole financial system, right? And if enough people started doing that, we could live. When people that aren't into crypto, I don't know what they're going to do. It's not going to be fun. It's not going to be fun for any of us, but so that's not that I'm saying I don't sleep at night because of this, but the reason I do sleep pretty good is because I know that I have an entryway into crypto, and I could ramp it up more, or I could at least have a start, a little nest egg or something if things got really bad. And then the other thing too is that what are other assets that are outside the system? Gold is outside the system, but not. Are there other real world assets that cash would be terrible? Like maybe I've got some real estate or something. I don't know how that would work in a real big collapse, but that's the reason I think we're all looking into this and talking about it. And we'll get back to crypto for sure, but it's interesting that you went back to this, Brianna, because I've been on a tear about learning as much as I can about all this for about the last 2 months. And I'll cycle out of it, but I feel better just understanding it a little bit more. And we're by no means experts. And this is a very high level overview. But I feel that most people don't even understand at this high level. And hopefully you learned a couple little things. Nothing that it was too shocking and surprising. It's like everybody's heard of it. Everybody gets it. But this was a little bit of the minutia that this happens every 5 to 8 years, and every 100 years it gets really bad. And we're nearing that 100-year mark. Okay.
That was really great. That was a very great presentation. And a lot of the questions, I just wanted to add, a lot of the questions that I had come to mind while I was listening were answered, which was nice. As you went through. So that was just done really well, very informative. There's so much to consider. I just start looking at these cycles and really zooming out and trying to figure out with the varying factors how we continue to have the cycles. That's a piece that will remain a question to me. But yeah, it seems like the more you zoom out, you just continue to see the cycles. It's very interesting. Not a lot has changed as far as a lot changes in our world. And one thing that I noticed that you can relate so much to finance and investing to just our personal life. So I talk about this quite a bit in the things that I do. And one of the ways that you can just help prepare yourself, at least the way that I've helped prepare myself, that's benefited me, is by diversifying my mindset. So not being completely honed in to where I'm consumed by what's happening in the economy, not giving away my power to that. And that's a way to prepare as well, is prepare your mindset, get into a place where you look at maybe the silver lining a little bit more and have a game plan in place, because there's so much opportunity. You know, there's people just waiting for this to happen and crash so that they can start taking on the opportunity that they've learned from the history of these crashes and these recessions and the ways that you can really benefit. But that's just my 2 cents to my input. I think that kind of just being lighthearted about it all is helpful, and preparing in ways that you can. There's more ways that you can prepare mentally than you can always do physically when it comes to some of the monetary ways. If you can't do it monetarily, do it in your mindset.
Yeah, I love it. Diversify your mindset. I love that quote. It's a good quote. And it makes perfect sense. And that's, tap into some of the stuff that I know Brianna talks about in her book and her classes, and I talk about it in my book, Be the Hero of Your Life. And it's do whatever it takes. I would say for me, when it's hard to turn this stuff off, I try to ramp up my meditation and my walking outdoors and that kind of stuff. Just use all the tools that are out there. And the thing is that I spent 10 years doing nothing but that for a while, because I went through a lot of health problems, and then I did nothing but meditate and try to de-stress my life. But economically, I was clueless and I almost ignored it. I think we talked about that and share that simile. It's almost, I don't want to talk about that. I don't want to think about that. And that wasn't helpful really either. And so now I feel like both of us, and that's what we're trying to get out there. The message is like, it's be whole, holistically. Finances are a part of it. You cannot ignore it. Take responsibility. It's why I love crypto so much, because the antithesis of crypto is to take responsibility. Don't let other people take responsibility for your money, because if you do, then you're at their whims. They can shut you down. But it should be holistic, right? And if we're too stressed out, we're not going to make good decisions about our finances anyways. It all works together. Okay, that was a lot of fun. Good show, dense. If anybody has any questions about it, we would love to talk about it. Or if we slid over areas that we didn't really go into detail or didn't make sense, let us know. We're still learning ourselves, but this is our focus now, or one of our focuses. And we'll be glad to dive in and get some more detail about any areas that you guys have questions on. All right.
Definitely a great show. And Tigran, if you're still in here, thanks for chiming in. Great to hear from you. And yeah, we'll see you guys on the next one.
See you.